Hey everyone, Suzy here from Adventurous Real Estate Investors. Today, I'm going to chat with you about vetting the deal and the importance of the deal. So once you have found that sponsor that you know, like, and trust, and you have the same investment thesis, whether that is you want 50% of your return to come from cash flow or 50% of it to come from appreciation, or you want majority of it to come from appreciation because you like to take on a little more risk. Both are totally fine investment strategies, but once you have found that sponsor, a great thing to look at is the market and then the deal themselves every time that they have something come in, because a big part of real estate investing is diversifying. So whether that's with the sponsor, whether that's with the commercial real estate asset class, or just the asset class, or just like where it is geographically, right? All those things are super important. So there's a couple things I want to talk about within the market, which is population and job diversity. When you are thinking about population growth though, or even the population in general, who is moving into the area? Who already lives in the area, right? Are the people who are continuing to stay a younger generation who are more likely to rent? Are the people moving in to the area more likely to rent in that area? You know, those things are pretty big to look at. Are there any incentives for people moving into the area? Because that's huge, right? If the incentives are to work remotely and get a, stipend for moving to that city, that is significant just in the fact that a lot of younger people who are willing to rent will pick up and move just because of that incentive. So that's one thing to look at. But then job diversity. How many different types of industries are there? How many different types of employers are there? If there's only one industry or employer, that is huge, and they suffer from a loss or downsizing, the balance allows for the sustainment in many jobs in other industries and from other employers, right? So if somebody has to leave or somebody has to shut down a plant, you have all the diversification from all the other employers in the area. And that is why that's huge. You want to see, does one main industry take over? Is there a huge, or are they all kind of spread out? Like, you want numerous Fortune 500 companies. You would like new facilities coming into the area. Like, just who is moving their business to that city or to that MSA and why? Because the why is the biggest thing, right? You could see a path of progress happening, which is huge now, because in those cities, usually you can find great deals still. So out of the two, remember that is the job diversity and the population. Just kind of look at those things once a sponsor has sent you a deal. So when you're getting into the numbers, into the deal, there are a couple of things I also want you to look at, which are the rent growth and the reversion cap rate. So why is the rent growth important? So the rent projections are fundamental to the deal. They're one of the most important parts. So in the numbers, some sponsors will assume positive annual rent growth. And to you should be attentive. There are two common areas to watch. That's projecting too high of rent growth in the first year and projecting consistent year-over-year rent growth in a holding high period. And I want to bring this up because it can take a year for your business plan to even get stabilized. It could take a whole entire year. So you're not going to be able to raise rents immediately. And say you hear the rents are 20% below market rate. Well, this is also huge because you can't just add on $400 to everybody's rent. You're going to lose majority of the people there. So if you do lose the majority of the people there, and you have to renovate all of those apartments, you're going to have vacant apartments for a while. So it does take a little bit of time. So just look out for that rent growth throughout the entire deal. So with the reversion cap, so another important assumption in the deal is to watch out for reversion cap rate, or the cap rate at which the syndicator estimates the property will be sold at. So this is huge because if you bought the property at a 5% cap rate, and the cap rates in the area are now at 7%, it is super important to be conservative. You don't just want to assume that a reversion cap rate at 5%, the same at which you bought it at, is what you'll be able to sell it at. The conservative approach is to use a higher cap rate and perhaps 2 basis points per year higher. And that's really important to look at. We do have another video about cap rates, so definitely go check that out to kind of get a better understanding of what cap rates are and what that means. But that is another pretty big thing to look at. So just to reiterate, once you have found the sponsor, you kind of want to check out the population and the job diversity in that market. And within the deal, you want to look at the rent growth and the reversion cap rate, the cap rate at which the syndicator thinks that they'll be able to sell at. So I hope that you enjoyed this video and learned a lot. If you did, please smash the like button and ring that bell so that you can receive notifications when we put out new content. I hope you all have a great day. Until next time, explore more adventure rates. Woo!